Good morning. This is Japanese Economic Review Channel. Today, we will examine the macroeconomic outlook for the week of August 10, 2026, and explore a structured, taxonomy-driven approach to portfolio optimization. Global financial markets are currently entangled in a highly complex web of macro forces. These include bilateral currency interventions, escalating geopolitical tensions in the Middle East, and a severe valuation test for high-flying AI and semiconductor equities. In the first half of this presentation, we will dissect the immediate catalysts that are tightly coiling the market. In the second half, we will map out the comprehensive asset taxonomy of the Japanese financial ecosystem. Our goal is to equip you with the strategic tools necessary to navigate this volatility and build a resilient, multi-layered portfolio. Let us begin. Let us start by establishing our baseline metrics. As of our latest data, the Nikkei 225 closed at 65,606 yen and 71 sen, marking a substantial weekly gain of over 1,244 yen despite a minor Friday dip. Technically, the Nikkei's 5-day, 25-day, and 75-day moving averages are converging tightly around the 65,000 level, acting as a heavy resistance zone. Meanwhile, U.S. equities remain robust, with the NY Dow standing at $54,036.93, and the USD JPY has consolidated at 157 yen and 76 sen. What these numbers tell us is that the market is in a high-level holding pattern. Driven by a suppressed summer trade volume, indices are temporarily flatlining as investors hold back, waiting for the next major fundamental trigger to determine the medium-term direction. Why is the Nikkei trapped around the 65,000 mark? The answer lies in the intense tug-of-war between powerful bullish and bearish forces. Supporting the market from below are three key factors: a temporary de-escalation of geopolitical tensions between the US and Iran, proactive fiscal expansion from the Takaichi administration, and high consumer expectations regarding proposed food consumption tax cuts. These elements are injecting strong sentiment into domestic-focused sectors. However, these bullish drivers are countered by heavy bearish pressures: acute valuation anxiety in the AI and semiconductor sectors, residual anxiety over coordinated currency interventions, and macro uncertainty ahead of the upcoming US CPI release. This perfect balance of opposing forces is what keeps equities pinned in this tight, wait-and-see corridor. The primary engine of the market's year-to-date rally, the AI and semiconductor sector, is facing a critical valuation hurdle. Because many of these tech stocks have multiplied in value since January, the bar for earnings has been set exceptionally high. In this environment, merely good earnings are no longer sufficient to sustain upward momentum. Companies must provide extraordinary proof of accelerated growth to satisfy demanding valuations and absorb the overhang of profit-taking. We face two vital litmus tests this week. On August 10th, TSMC will release its July sales, revealing the immediate pace of global hardware demand. Then, on August 13th, Applied Materials will report its earnings, offering a direct window into capital expenditure trends for chip-making equipment. These numbers will confirm if the AI growth narrative remains intact. In the foreign exchange market, the dynamics of the yen remain highly influential for Japanese equities. Coordinated bilateral interventions successfully pushed the USD JPY down from its highs, establishing a temporary policy-driven floor around 155 yen. However, this has not reversed the underlying structural trend. Continued fiscal expansion and tax cut initiatives in Japan keep long-term fiscal concerns alive, sustaining natural downward pressure on the yen. Concurrently, hawkish statements from Fed officials, hinting at potential September rate hikes if U.S. inflation spikes, support the dollar. Consequently, the yen has steadily depreciated back to the 157 to 158 range, while 160.00 represents a clear psychological ceiling guarded by the threat of further interventions. The stabilized yen above 157.00 provides a reliable cushion for major Japanese exporters. To manage a portfolio effectively, we must map out immediate risks based on their potential severity and probability. Currently, our highest probability, highest severity risk is the upcoming U.S. inflation data. A hot CPI or PPI reading would instantly reignite fears of Fed rate hikes, sparking global market liquidations. Next, we must monitor geopolitical risks in the Middle East. Any sudden escalation that disrupts energy supplies could spike crude oil prices, threatening the fragile disinflation narrative currently priced into global assets. Finally, these risks are amplified by the Obon holiday in Japan. Thin liquidity and low trading volumes mean that any unexpected macro surprise can trigger disproportionately large price swings, making risk mitigation crucial. Let us look at the operational timeline for the upcoming week. While Japan observes the Mountain Day holiday on Tuesday and experiences lower domestic participation due to the Obon Week, the international economic calendar remains incredibly dense. On Monday, we received the BOJ's opinions and TSMC's monthly sales figures. Wednesday brings the undisputed highlight of the week, the U.S. July CPI report. On Thursday, we analyze the U.S. PPI and Applied Materials Q2 results. Finally, Friday concludes with the local options SQ and the release of U.S. retail sales. Given the thin liquidity, investors should prepare for heightened intraday volatility surrounding these data releases. Based on our risk catalyst analysis, we have defined the Nikkei's expected trading range at 63,500 to 66,500 yen and mapped out the exact conditions for a breakout. An upside breakout above 66,500 requires a perfect convergence of positive factors: a cooling US CPI that reinforces rate cut expectations, strong sales from TSMC and AMAT, and progress toward peace in the Middle East. If these occur, growth capital will flood back, resuming the AI-led rally. Conversely, a downside breakout below 63,500 would be triggered by a hot inflation reading, disappointing semiconductor earnings, or a geopolitical shock that spikes oil prices. In this scenario, thin holiday liquidity could accelerate panic selling, forcing a broader market correction. To navigate these volatile macro scenarios, we must move beyond simple stock picking and understand the structural mechanics of the market. This slide introduces the financial ecosystem taxonomy. Our investment universe is divided into three functional layers. The base consists of core, liquid assets. The middle layer introduces advanced instruments designed for leverage and portfolio hedging. The top layer comprises tax-advantaged structures and automated wealth management tools. Fluency across this entire taxonomy is what separates sophisticated capital from speculative trading, allowing you to deploy the right tool for the right market environment. Let's examine each layer in detail. The foundation of our taxonomy is level 1. Core asset classes and fixed income. Within equities, investors can access standard spot and margin markets, IPOs, and single share accumulation plans. Crucially, in the current high-yield environment, foreign currency money market funds, MMFs, and foreign sovereign bonds represent vital tools. Rather than letting cash sit idle during periods of equity volatility, shifting capital into foreign currency MMFs allows you to capture stable, high single-digit yields while maintaining immediate liquidity. This defensive core provides a highly reliable income stream when stock markets consolidate. Level 2 of our taxonomy introduces advanced derivatives and alternative assets. These instruments are designed to actively manage risk and capitalize on price dispersion. Investors can utilize spot FX to capture yield-focused swap points, or deploy Nikkei 225 options, such as purchasing protective put options, to safeguard equity portfolios against sudden market drops. Additionally, this layer features precious metals like gold, silver, and platinum. In an era of geopolitical instability and persistent inflation threats, gold serves as the ultimate historical hedge, preserving purchasing power and acting as a non-correlated stabilizer when traditional equity markets face a correction. At the apex of our taxonomy, we find level 3, tax-advantaged structures, automated wealth, and digital assets. NISA and IDCO represent the most powerful tax-shielding mechanisms available to domestic investors, allowing capital to compound entirely tax-free. For investors seeking hands-off management, AI-driven robo-advisors and wrap accounts automate asset allocation and rebalancing dynamically as macro conditions shift. Furthermore, the emergence of blockchain-backed security tokens, traded on private venues like ODX, opens up access to tokenized real estate and alternative assets, democratizing high-barrier investments and introducing new diversification streams into the modern portfolio. To conclude, let us synthesize our strategic playbook. We are navigating a coiled market, a landscape compressed by summer-thin volumes but highly sensitive to near-term macro events. In this environment, successful investing is not about predicting a single direction. It is about structural preparation. By mastering the complete asset taxonomy, you can implement a multi-layered strategy, rotating long-term capital into tax-advantaged NISA plays for domestic value stocks, utilizing foreign currency MMFs to secure stable yields, and allocating a portion to precious metals and options to hedge against geopolitical and inflationary shocks. Strategic flexibility is your ultimate competitive advantage. Thank you very much for your time, and I wish you all the best in your investment journey. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.